This LOS is compare the risk and return characteristics of different types of equity securities. Risk and return characteristics of equity securities. So first we're going to look at the return characteristics of equity securities. And there are two main sources of equity securities total return: price change, or the capital gain, and the dividend income. The price change represents the difference between the purchase price at T minus 1, or sometimes we see the nomenclature as P naught, and the sale price of a share at the end of the time. Okay? Cash or stock dividends represent distributions that the company makes to its shareholders during period T. Therefore, an securities total return is calculated as this. The return is the price when you sell it minus the price when you bought it plus the dividend divided by the price that you bought it at. So it's really just the holding period return. This is not too complicated. Ending price minus beginning price plus the dividend divided by the beginning price. For investors that purchase depository receipts or foreign shares directly, there is a third source of return, which is the foreign exchange gains or the losses. Since we're talking about dividends here in terms of the return characteristics, I just wanted to recall from the introduction to corporate finance, and we've seen this in portfolio management, that when we've been looking at the Ibbotson data for U.S. large cap data at the beginning of 1926, the total compounded annual return with dividends reinvested from the beginning of 1926 to the end of 2008 was 9.6%, as compared with 5.3% on the basis of price alone. So dividends are very important with regards to the total return calculations. So this is just an easy practice question. Calculate the total return on a share of equity using the following data: purchase price 50, sale price 42, and the dividend paid during the holding period is $2. So is the return A minus 12%, B minus 14.3%, or C minus 16%? Okay, that's a really easy question. So again, the holding period return is the ending price minus the beginning price plus the dividend divided by the beginning price. Or using the nomenclature in the text, RT equals PT, the price at the time you sell it, minus PT minus 1, that's obviously the price you bought it, plus the dividend at time T. Again, often the question is assuming you receive the dividend at the same time that you sold the stock, and it's divided by the price T minus 1, which is the beginning price. So therefore, the total return, 42 minus 50 plus 2 divided by 50, and that's negative 12%. Risk and return characteristics of equity securities. So now we're going to look at the risk of equity securities. The risk of any security is based on the uncertainty of its cash flows. The greater the uncertainty of its future cash flows, the greater the risk and more variable or volatile the security's prices. Okay? So preferred stock is less risky than common stock because it's a fixed dividend. That's less uncertainty. It receives distributions before the common stock, and there's a claim to par value if the firm is liquidated. Okay, so you can get your par value back. So if it's $100 preferred, there's a claim to that $100. Callable common or preferred stock is more risky than non-callable. Why is that? Because remember, the call option is with the issuer. They have the right to call the stock back, but not the obligation to. Okay, but they've bought that right from you, so your price of your callable common would be less than a similar common share without that option. Puttable common or preferred stock is less risky than non-puttable because that gives the investor the right but not the obligation. Again, you've bought that right, you've bought that option, you've sold that to the issuer, so a puttable common or preferred stock is going to be more expensive than a similar security without that option. And finally, cumulative preferred is less risky than non-cumulative because, as we said, with a cumulative preferred, you have to be paid your dividends that have been missed before any dividend distributions can be made to common shareholders. Okay, and that's the last slide for this LOS. Thank you.